Happy Friday, everyone, and welcome back to OETV. Always got a great show for you on Fridays because you know who that's with? It's with Jay Pelosky. How are you, Jay?
Hey, Scott. Good to see you, buddy. I like that golf shirt. You going to get out on the links later?
I will be. I'll be hanging around here to the close because it's a very interesting market this week, obviously, and we're going to talk about that. But I will be teeing off after the close. So probably I'll get like 15 in.
There you go. Awesome. Good for you. Hit him hard.
Well, as we know, it's the start of the month. And as we do at the start/end of the month, we have your monthly review, which I always look forward to because it's great to look what's happened through the month and look to what's going to happen in the future. So this month, it's titled Jackson Hole's Real Message. And to be honest, I thought we had the real message last Friday, didn't we? Like when the market got tattooed. Like, wasn't that the real message from that? Or what is the real message?
Yeah, well, that's kind of the point, right? That the market did get tattooed and the equity market did. Not much else moved on Friday, but over the last couple of days, obviously, it's been weak pretty much across the board, right? Stocks have sold off, bonds have sold off, commodities. So it's been a fairly ugly state of affairs. But to us, the real message, we think over time, in history will suggest that the real message was the beginning of the validation of what we have called the high nominal growth world. And Chair Powell's comments obviously got all the billing, but in a lot of the conversations and other papers that were delivered over the course of the meeting, there is a lot of talk about the end of the low inflation environment, a lot of discussion about what replaces it, even some discussion about the need to perhaps shift to a 3% inflation target rather than 2%. And as you know, when we've talked about it for quite some time, we are of the view that we are in a high nominal growth world. And we're going to stay in that high nominal growth world driven by the global CapEx boom we see unfolding to deal with COVID, climate, and conflict. So that to us, we think is going to be the real message over time, is that Jackson Hole was the beginning of the acceptance of the fact that we're in a high nominal growth environment, and it's not worth it for the Fed to grind inflation down to 2% and really damage the economy, particularly when we have one of the most aggressive fiscal tightenings, which gets no play at all. But the budget deficit this year is going to halve from last year. And to put that in comparison, in the great financial crisis, it took 4 years for the big deficit that rolled out in 2009 when we were trying to support the economy to halve. Here in 2021, obviously deficit was about 10% of GDP. This year, it's going to be about 4.5%. So that should give the Fed comfort. And then the fact that inflation expectations remain very well anchored should further give the Fed comfort that it can ease into a 2.5% to 3% type inflation environment, and things are not going to go haywire. We think that's really going to be the takeaway at the end of the day.
Well, Jay, I actually want to go back on one thing we discussed last week, which you were talking a lot about, was the nat gas prices in Europe. Like, have you had a look at those again this week?
Well, I have to say, Scott, thank you for mentioning that, because I think I nailed it, right? Did I not nail it?
You did. 100% you did.
Yeah, I think my term was massive crash ahead, right? And so this week, what happened? German 1 year forward power prices fell by 50% in 1 week. 50%. All right, the Dutch natural gas price, which is the benchmark for Europe, has fallen about 35% this week. So yeah, that was, that's another part of our focus, right? We had the tripolar world, the 3 keys for the second half. In the US, it was inflation rollover. In Europe, it was the path of energy prices. And in Asia, it was China's moving out of lockdown. And so it just makes no sense to me. I mean, the storage data in Europe is way better than expected. The target was to hit 80% by November 1st. The majority of countries, as we show in the monthly, we've got some great charts in the monthly this week or this month. As we show in the monthly, the majority of European countries have already hit the 80% storage. We also show some work which suggests that Germany which is the epicenter of all the fear, may well get through the winter without rationing, unless it's a very bad winter and Russia shuts off the gas completely. Absent those two things, really bad winter, complete shut off of gas, we think, and others are starting to write and report, that Germany will get through the winter without rationing. So we've gone way overboard on that, or the markets have gone way overboard on that fear. And it's good to see some of that reverse itself this week. And I think there's a lot more where that's going to come from. We're not even close to the end of the pullback in energy pricing in Europe. And that obviously should be very constructive for the euro, should be very constructive for European assets. I think I mentioned last week, but B of A reported recently, European equity funds have had 28 straight weeks of outflows. 28, that's 7 months of consecutive outflows from European equity. I mean, you know, call me crazy, but at a parity with the dollar, 28 weeks of outflows, valuation as compelling as it's been in about 20 years versus the US. I think you can close your eyes and buy European equity with a 1 year, 3 year type view and do very, very well.
Very interesting. Well, I also saw some people being negative on Europe in this week, but let's stick with like what
there's no short. That's the point. There's no shortage of negative people. 28 straight weeks of outflows. You know, come on.
One-way traffic.
Yeah. So it makes it very difficult to stand in, and these markets have made it really, really difficult, right? If you have a different view than the market, you've got to have a really strong stomach, because this is a punishing type market. I mean, I think John Kovalos at MRA Advisors, who I like a lot, he put it really well in his piece this week. He called the current environment a technical torture chamber. That's what it feels like. So yeah, if you're long European equity, which, you know, hello, we are, it's been tough, but I think going forward, as I said, euro at 1, 28 weeks of outflows, valuation extremely compelling, European energy fears way, way, way overdone. You know, I think Europe may even skirt a recession. People forget, you know, record low unemployment in Europe too. You know, lots of demand post-COVID, fiscal support. They're not cutting their budget deficit in half in Europe. They're providing fiscal support. So the policy mix there is better than it is here in the United States. And of course, you know, people could care less, but at some point they will.
Well, let's move on to what we always do, or what you always do, I should say, when we do your monthly pieces, and that's go through a global risk nexus. Let's break it down. Let's start with climate.
Let's break it down, baby. I love it. Sounds like football talk. Very excited about football season starting, as you know. Yeah, climate is, you know, what we think is the single biggest global macro trend. We think investors have to be exposed to it. And the climate news over the last couple of weeks has been great. The climate bill in the US, $370 billion to be spent over the next decade. McKinsey and others have come out saying they expect to follow on $1 trillion or more of private sector funding. You've seen tremendous activity already in the electric vehicle space on the transportation side, right? We break climate down in transportation and power generation. Those are the two big carbon emitters. On the transportation side, it just, you know, every week, every day almost, you see a new news item about some company setting up an EV battery plant, because increasingly part of the climate act of the Biden administration was increasing the local content. Has to be done and made in North America. So you're seeing, like, within weeks, you're seeing companies saying, okay, we're in for $1 billion, we're in for $2 billion, we're setting up a plant here, we're setting up a plant there. And you've already seen the old, you know, negative designation, the Rust Belt, right? Scott, you know what it's called now, right? You know what the new name is?
No, what is it?
Battery Belt. Because there's so much money going into Ohio and and Michigan and these places to create the ecosystem for the electric vehicle environment. So very, very good news there. And then on the power generation side, nuclear power is back, right? Back in it with a big way. And the news there was really in Japan, where Prime Minister Kishida overturned the taboo of Fukushima, right? When the plant suffered a meltdown, or not a meltdown, but you know, suffered a severe issue after a tsunami hit a decade ago. And Japan is now back in the nuclear power business. And let me just read you the quote that we pulled from Bear Traps. I don't know if you know Larry McDonald, but he does really good work. Anyway, his quote on uranium, listen to this. "The fundamentals are the best they have ever been in the history of nuclear energy." Fundamentals best they've ever been in the history of nuclear energy. So happy to say that we have a pretty good exposure with our URNM, the uranium miners, as our play, both in our global multi-asset model, as well as our TPW 20 thematic model. We're big believers in nuclear power, big believers in uranium, and it's heartening to see guys as expert as Larry saying the fundamentals are the best they've ever been.
Well, it's, just looking at the uranium, the URNM ETF there, it's been a good performance this year, up 12.3% year to date.
Yeah, exactly.
All right, let's move on to economics. And obviously there's quite a lot going on in that space.
Yeah, well, we had the jobs number today, right? And we were talking about it before we went live. A very good number, right? The 3-month average jobs have moved from 540,000 in Q1 to about 380 right now over the last 3 months. So partly Q2, partly Q3. So that's a 30% decline. That's what the Fed wants to see. Labor participation up, that's great. Fed wants to see that. Average hourly earnings below consensus, that's great. That's one of the real concerns, right? The famed wage price spiral. So I think we're setting up, you know, what's real interesting is if we get a really soft inflation report in whatever it is, 10 days or so from now. If that happens, wow, watch out, because the market is completely unprepared for any such event. And we are of the opinion that inflation is going to fall faster than expected. All the transitory stuff is collapsing like stones, right? Whether you talk about the commodity prices, gas at the pump down 75 or whatever it is, 77 days in a row. Wheat prices down 40%, used car prices negative on a year-over-year basis, supply chain issues completely back to normal. So we think we're set up for faster than expected inflation decline. When we look at labor and housing, quits ratio in labor already rolled over in housing. I mean, wow, what an epic collapse in activity in housing over the last couple of months. I mean, I don't know if people are aware, but new home inventories are back to the levels last seen in 2009, okay? At the depths of the housing bust in the great financial crisis. That's where we are in inventory levels right now in the United States. So we think rent, et cetera, you know, takes time, but we think we're in the right direction. We think recession risk is greater in Europe than it is in the US, but as we touched on, even there, we don't think it's going to be particularly strong. And in Asia, we're increasingly of the view that China has drawn a line under the property sector and is going to provide continued support. So our view, in essence, remains that middle path view. Again, you know, the view we've had for months and months and months, right? All through this period. We're of a middle path. So inflation falls, growth is slow, but still ongoing. No recession, or certainly not a deep recession in the United States. That middle path keeps us constructive.
Okay, and then let's move on to politics. Obviously, we had Biden speaking last night. none of the big networks covered it. But I think, well, having a quick look at your musings, you think it's getting a little bit tighter with 90 days to go until midterm.
Yeah, without a doubt. I mean, clearly, you have a number of factors. His polling numbers are now better than any of his 5 predecessors at the same time, which gets, again, virtually no attention, but it is accurate. You know, the Republicans are putting up candidates who nobody really likes other than the most MAGA of MAGA people, and that's, you know, that's a result of gerrymandered constituencies and primaries where you have to go tack to the far right to win the primary, but they're not electable. So the Senate probably is going to remain in the hands of the Democrats. The House, which was a foregone conclusion of being going to the Republicans, may not turn out to be that way. Certainly abortion and the Supreme Court decision there has led to dramatic increases in the number of women registering to vote and quite likely going to come out and vote. You know, we'll see, but it looks as if it's going to be much, much tighter than one would have thought even 2 months ago. And then elsewhere, you have the Brazilian elections coming up in a month or so. Lula looks like he's going to return to the presidential office in Brazil. You have the Italian elections. Looks like a center-right coalition is going to win there in the next couple of weeks. That's in this month in September. And then the big deal over in Asia is President Xi in the People's Party Congress, which we got a date this week, middle of October. That's earlier than people expected, which suggests that President Xi is in good shape to get his 3rd term, an unprecedented 3rd term in China. And at the same time, probably suggests they want to move forward on some of the economic issues. And they know that it takes that we've got to get that meeting out of the way before they can really address aggressively some of the policy issues that are clearly still confronting China.
Okay, well then let's move on to policy. And obviously, you've titled your musings this week or for the month on Jackson Hole, 75 bips, and that's like everyone's expecting now. What else are you seeing on the policy front?
Well, I think that's really the key, right? We're really focused on the dollar right here. We think the dollar is the key to unlock a lot of asset allocation shifts that have been bubbling and building under the surface for months and in some cases years, and really haven't had the chance to manifest. And so the way we're looking at things is we expect the Fed to raise by 75 basis points unless we get, as we talked on a minute ago, a very, very soft inflation number. But after Jackson Hole and Chair Powell's comments, they've got to do 75 basis points. So we think more importantly than that is the fact that it will be the last of the 75 basis point front loading exercise that the Fed has done. Unprecedented front loading of the rate hike adjustment. And we think that end of the front loading is also likely to signal the end of dollar strength. And that suggests an opportunity for the dollar, which looks, you know, across a number of areas kind of worrisome. It could really roll over. On the European side, we're expecting these energy fears to ebb, as we touched on at the top, right? 50% collapse in 1-year forward power prices in Germany just in the last week. And that should provide support to the euro, as well as, I think, the realization that we do think the ECB is likely to do more tightening next year than the Fed, right? That's not really where people are at yet, but we think, I don't know if the Fed's going to cut rates next year, but I don't think they're going to do much raising of rates, all right? And the ECB, given where inflation is and the fact that it's, you know, going to take some time to really bring it down, we think, and the ECB is obviously way behind the Fed in terms of, you know, interest rate levels. We think that the surprise is going to be that the ECB raises more in 23 than the Fed does, which again supports the euro. And then third, we're really focused on kind of the desynchronized nature of the economy, with US and Europe slowing and China, Japan, and Asia starting to recover. And that desynchronized nature plays out in the policy side as well in the central bank action, because we just talked about the Fed, 75 basis points, ECB having to hike more. But guess what? In Asia, Bank of Japan, doing nothing, right? And PBOC, People's Bank of China, cutting rates. So that's that desynchronized nature again, which we think supports a global economy that's able to withstand recessionary risk.
Okay, well, listen, the market's had as we move on to the last part of the markets, they've had an interesting week, like S&P small down, NASDAQ a little weaker and so forth. We finished the month, obviously, in the hole on the back of Jackson Hole. Where are you seeing the markets right now?
Yeah, well, I mean, August was a pretty ugly month, right? Down 4%. And globally, equities were down as well. Bonds sold off. So it was another one of those, kind of ugly, didn't matter really where you were. Commodities were weak. Oil was down for the third month in a row. Copper's been weak. Gold has been weak. So August was a tough month. I mean, really, we're a global multi-asset investor. We have our model portfolio as positions across equities, fixed income, and commodities. And it wasn't a great month again. So the question is not that we get a little bit of a pullback, because July was quite strong, and markets again in these thin markets where technicals are so important, because the history really isn't very useful given the ahistorical nature of the environment that we're in. Technicals really drive things, and the S&P went right back to its 200-day average, right, and failed and came back in. And then we had Jackson Hole, so people piled on the short side of things. The question is, what do you do about it, right? And from our point of view, we continue to be constructive, right? Our focus has been on that high nominal growth world, which supports earnings. Remember, we wrote earnings bridge now 5 or 6 weeks ago, and look, that's playing out. I mean, Morgan Stanley reported just this past week that there are more companies guiding higher than lower for the second half of the year coming out of Q2. Okay, that's not at all what you would think, given reading the headlines and looking at the price action. More companies guiding higher than lower in the U.S. And so we remain constructive, and really our focus is on a couple of things, as we touched on, right? Fed finishing front loading, dollar rolling over, global CapEx boom in that high nominal growth world. And so we're really honing our attention, and we have been, as you know, for the last couple of weeks, the last month or so, on emerging markets, right? We think emerging market assets could have really significant upside for a number of reasons. First, if we get this CapEx boom, it should be good for commodities, right? Weak dollar should be good for commodities. Who has a lot of commodities? Emerging markets have a lot of commodities. So right there, that's supportive for EM. Broad EM on the equity front is back to levels versus the S&P that it was 20 years ago, right? So we're right back on a relative performance basis. And again, charts are in the monthly. Please take a look at the monthly. It's got 23 charts and tables from 15 different sources this month. I counted it out myself. And so we are in that view that emerging markets really has an area of opportunity for people to participate at a 20-year relative low versus the S&P, beneficiary of commodities, big beneficiary of a dollar rollover. And by the way, the emerging market central banks are closer to the end of their rate hiking cycle than probably anybody else, because they started hiking rates last year, well in front of the Fed. And so for a number of reasons, we're really pretty constructive on emerging markets. And I just point out that when you look at the dollar, technically it looks very exposed, and we have some great charts on that. Fundamentally, the current account deficit in the US is now over 5% of GDP, typically a real warning area. And foreign investors, because the US has been such an area of outperformance over the last 10 years plus, since 2009, foreigners now have a net 17 trillion, Scott. I know that even for you, that's a big number. $17 trillion in net U.S. financial asset ownership. So if they start to think about opportunities back home and pull some of that money, that reinforces the dollar weakness. So I think we could be on the cusp of a virtuous circle developing for non-US and for emerging markets. And so that's a big focus for us. And then the last thing I'd say is the climate space, right? The thematic space. We've talked about it, how innovation bottomed back in the spring in April and May. We talked about climate bottoming in May, well ahead of the broader markets. And so we continue to really be focused on the thematic space, on the climate space. And you mentioned URNM up 12% year to date versus ACWI down 15% or so, so massive outperformance. Here's another set of performance numbers for you, and we'll end here. ICLN, which is a clean energy ETF in both our global multi-asset and our TPW20 thematic model, down about 5% over the last year. So not year to date, over the last 12 months. ACWI is down about 16 to 18% over that time period. In crypto, the other C, GDLC, is down about 80% over that period. So the thematic space is one where we think we can generate some alpha, and we're very focused on it. And within that, climate is the single biggest segment of our model, our thematic model, our TPW20, as well as the biggest part of our thematic sleeve that we have in our global multi-asset model.
Jay, there's a lot to take in from that, and there usually is the month-end one, and some great insights, obviously. But I've got one last question for you, though. 7:30 tonight, Temple versus Duke. Line 6.5. Duke is the favorites. Where am I supposed to be going with this?
Oh yeah, Duke, yeah. I feel really good about tonight's game. I think it's the beginning of the Coach Elko era. Mike Elko, a new head coach at Duke. He's got a great staff. I know the kids have worked very hard in preseason, and I think Duke is on the way up in football. Here's another kind of investment opportunity if you want. Duke football over the next 3 to 5 years, I think, is going to be one of the surprise stories of college sports and college football in particular. See a lot of upside.
Well, I love the course there. I have played down their golf course before. But, Jay, you know what? Have a great long weekend. Enjoy the game tonight, and good luck.
Thank you, Scott. Same to you. Enjoy the golf. And I'm not sure who you root for. I know you're a rugby guy, so I'm not sure who you root for football-wise, but enjoy whatever game you happen to watch. And hopefully you get to watch a little bit of Duke's victory tonight.
Let's go Buckeyes.
There you go.
And for everyone else out there, good luck investing.